Most people start a business the wrong way, and they don't find out until it's too late. Hey, I'm Astrid, and today I'm going to teach you something that could protect everything you've worked for: your savings, your car, your home, all of it. Because right now, if you're running any kind of business without understanding what I'm about to explain, you could be one bad day away from losing things that have nothing to do with your business. We're talking about business structures, LLC, corporation, sole proprietorship, partnership. You've probably skipped past those words because they sound boring and legal and like someone else's problem. But they might be your problem right now and you don't even know it. By the end of this video, you'll know exactly which structure likely fits you best, why it matters more than almost any other decision you'll make, and what can happen if you ignore it. Give me 10 minutes. And just to be clear up front, nothing here is legal or financial advice. Every situation is different, every state has different rules, and how your business is set up changes everything. What I'm giving you today is the foundation, the knowledge most people spend years figuring out the hard way. Before we go through the different types, I want to tell you about Alex. Alex is 27. He starts a freelance graphic design business from his apartment. He gets his first client, then his second. Money starts coming in, a few $1,000s a month. He's working for himself, building something real. Life feels good. He never filed any paperwork, never formed any legal entity. He figured, I'm just one person, I'll do it later when things get more serious. Then one day, he gets an email. A client is claiming Alex's work caused a significant business loss. They're holding him responsible. They're suing. Alex stares at the screen. Then he opens his bank account. And that's the moment it hits him. The money in that account isn't just business money. It was never separated. Because Alex never created a legal wall between himself and his business. They are the same entity. His savings, the money he'd been setting aside for months, all of it is potentially exposed. That is the oh shit moment that no one tells you about when you start a business. No structure is a structure. And it's the most dangerous one. A business structure is simply a legal container that holds your business separately from you as a person. It determines whether your personal life and your business life are connected or whether there's a wall between them. That wall, or the absence of it, can change everything. Let's break down each type. And as we go, keep in mind, this depends on your situation, your state, and how your business is structured. There's no one-size-fits-all answer. But there are patterns, and those patterns matter. Sole proprietorship. This is what Alex had. It's the default. The moment you start making money from any business activity without filing any formal paperwork, you are automatically a sole proprietor. No decision required. It just happens to you. Think of it like driving without insurance. You can go years without a problem. But the moment something goes wrong, you're exposed in a way you never fully appreciated until it was too late. With a sole proprietorship, there is no legal separation between you and your business. Your business debts are your personal debts. A lawsuit against your business is potentially a lawsuit against you. If things go wrong, in many cases creditors could come after your personal bank account, your car, your savings. The most dangerous part? Most people in this situation don't know they're in it. They think, I just have a side hustle, until one afternoon, they open their email and realize exactly how exposed they've been the whole time. General partnership. Now imagine Alex had a business partner. A general partnership is two or more people operating a business together with no formal structure, and it can be even more dangerous than a sole proprietorship. Because now you could potentially be liable not just for your own decisions, but for your partners too. Running a partnership without a legal structure is like giving someone else a key to your bank account. You trust them, maybe completely. But one bad call on their part and your personal assets could be on the line for a mistake you never made. There is a version called a limited partnership that offers some protection for certain partners. But the core risk of sharing unlimited personal liability with another person without any formal structure is one of the most underestimated dangers in small business. LLC, the wall. A limited liability company is, for many small business owners, often the most practical first step toward protection. An LLC is a legal entity you create by filing paperwork with your state, typically costing anywhere from $50 to a few $100s, depending on where you live. Once it exists, it's a separate legal thing. It can own property, sign contracts, earn money, and take on debt. And if it gets sued, in most cases the lawsuit is against the LLC, not against you personally. An LLC is like putting a firewall between your personal life and your business. The business takes a hit. In many cases, the firewall holds. Your personal life stays intact. In most cases, matters here. The protection has limits. If you mix personal and business money, if you never actually treat the LLC as a separate entity, courts can sometimes reach through that wall and hold you personally liable. The protection works when you respect the separation. LLCs also come with real tax flexibility. By default, a single-member LLC is taxed like a sole proprietorship. Income flows through to your personal return. But you can also elect to have it taxed as an S corporation once your income reaches a certain level, which could reduce your self-employment tax burden significantly. Most LLC owners never explore this. It's often worth a conversation with a CPA. One important note: LLC costs and rules vary significantly by state. Some states are very business-friendly. Others charge steep annual fees even if your business made nothing. Know the rules where you are. S corporation. An S corp is often used by profitable small business owners looking to reduce self-employment taxes. Income still passes through to your personal tax return. No double taxation. But there are strict limitations. No more than 100 shareholders. All must be U.S. citizens or residents. Only one class of stock. This makes the S corp poorly suited for any business planning to raise outside investment. But for a profitable solo business owner with consistent income, an S corp election through an LLC could save real money each year. This is a conversation for a CPA who understands your specific numbers. C corporation. This is the structure built for scale. Every major company, Apple, Amazon, every venture-backed startup, is almost certainly a C corporation. If you want to raise money from investors, distribute equity to employees, or eventually go public, this is likely where you end up. Most investors will require it before they write a check. The trade-off is double taxation. The corporation pays income tax on profits. Then shareholders pay personal income tax on dividends. The same money taxed twice. For a small business distributing profits to its owner, this is often a significant disadvantage. C-Corp also come with the most administrative burden: board meetings, formal minutes, bylaws, registered agents. For an early-stage business, this overhead can feel disproportionate. Most people don't start here. They grow into it. Here's the inversion that surprises most people. The option that requires zero effort, the sole proprietorship, the one that happens to you automatically, is often the one that leaves you most exposed. And the option that sounds complicated and intimidating, the LLC, with its paperwork and filing fees, is frequently the one that most people should have set up from the beginning. Your business can fail. The question is whether it takes you with it. Protection feels unnecessary until it's the only thing that matters. So here's how to think about all of this. If you're making real money from any business activity, freelancing, selling products, consulting, running any kind of service, forming an LLC is often one of the most important first steps you can take. The cost is relatively low. The potential protection is real. And as always, the right structure depends on your specific situation, your state, and what your business actually looks like. If you have a business partner and you haven't formed any legal entity together, that is likely the most urgent thing on your list. A handshake agreement between two people who trust each other is not a structure. It is an assumption. Assumptions get tested. If you're running a profitable business and want to explore reducing your self-employment tax burden, talk to a CPA about whether an S-Corp election might make sense for your numbers. And if you're building something with real outside investment ambitions, a startup, a scalable product, venture capital, a C corporation is likely the structure you're heading toward. Your business structure doesn't build your business, but it can protect it. Alex learned that lesson on the worst possible afternoon. You don't have to. Don't wait until you need protection to realize you never had it. See you in the next video.